All right, everyone. Good morning and welcome to another episode of the Resource Insider Podcast Quarantined Edition. If you are watching this on YouTube, you can see that I'm sitting in a different place. I have holed myself up at a cabin at Whistler. Don't worry, I am still fully quarantined. For those of you running the streets of Vancouver, scared that I might contaminate you, I went from house to car, car to cabin. So you're all safe. Today on the podcast, I am talking to a resource focused fund manager, and his name is Matt Geiger, and his fund is MJG Capital. They have been around for about 8 years now. Matt is heavily focused on the junior mining exploration space. He's everywhere. There's a lot of articles. There's a lot of interviews with Matt in it. He does a great sort of investors newsletter that I follow. And I'm excited to sit down with him today. We've never had him on the podcast before, and I probably should have had him on years ago. But we're going to talk about what the hell is going on in the markets. We're going to talk about gold's recent run, which is nice to see, and a whole lot of other stuff. So without further ado, Matt, thanks for coming in today.
Yeah, thanks for having me, Jamie. And I must say, appreciate being on the program here. I'm a big fan of what you guys do at Resource Insider. You guys have a lot of high quality guests, sharing a lot of knowledge. So pleased to be joining you.
Well, I appreciate that, and I'm glad to add your name to the list of high quality people. Now, to start off, for a bit of a background, you're in California right now. Are you in San Francisco? Am I right on that?
Yes, the resource capital of the world. I say that tongue in cheek, of course. That was the case 150 years ago, ironically, during the gold rush. San Francisco was ground zero in terms of mining financing. But it's funny how things change. That couldn't be farther from the truth today. Mining is viewed in the Bay Area as old-fashioned, stodgy, irrelevant industry, which I just think is ignorant, because all of the cool tech and all the stuff that we're inventing in the Bay Area wouldn't be possible without the metals and the inputs that we pull out of the ground. So I think there's a clear disconnect there, that hopefully people will start to wrap their minds around in the years and decades ahead. But
so that's kind of an interesting question, a good place to start. How did you end up in the Bay Area and end up running a mining fund when, it seems to me that half the United States and much of the world is flooding to that area for over the last few years to get into the tech space? Yeah, you took a bit of a contrarian approach. Is there a reason that you got interested in mining, and why base yourself there as opposed to a Denver or a Vancouver or a more traditional mining hub?
no, all good questions. I would say that, to answer the last one first, I do like being a bit off the beaten path. I think it gives me a little bit of an interesting perspective. And as you'd imagine, it's been a two-decade tech bull market here, really. There's obviously a blip, in 2008, 2009 around the great financial crisis, but there's a lot of money sloshing around. So I think it's a bit of an advantage to be able to stick out like a sore thumb, because there aren't many other resource fund managers in the area. Not a very clear-cut answer to exactly what drew me to the space. I don't have any mining in the family. I guess I did have a great grandfather that apparently worked in the Portuguese or in the Chilean copper mines as a supervisor. But other than that, no family lineage there. I guess the first aspect is I've always been appealed to the longer term narrative, where we're on a resource with planet with finite resources, and we have a population that's growing exponentially, and also consumption on a per person basis that's growing exponentially. That gives me confidence that mining is going to be just as relevant 80 years from now, when I'm a old man, hopefully still investing, just as much, if not more, than it is now. I was also drawn to the contrarian nature of it, as you mentioned, especially in the Bay Area for somebody my age. I mean, this couldn't be the farthest thing from what people are focused on. As I've gotten deeper and deeper into the industry, I have met bright and younger guys and women that are up and coming, but I think everybody would agree that there's a massive generational gap. There's a lot of white hair out there, and there's not too many younger guys to fill the shoes. And so I view that as an opportunity. And then the final point, real quickly, I mean, this is pretty much, besides from maybe the shipping industry, the most volatile and cyclical industry in the world, hands down. And most people are afraid of volatility and cyclicality. Obviously, when things are working against you, it's not necessarily fun. But I think there's an advantage there if you have the right temperament and the right value investing framework to actually use those two things to your advantage. And I think it's a natural fit for kind of my temperament and the investment strategy that we have.
Well, you're certainly getting your opportunity to take advantage of volatility over the
Yeah,
last couple
say
weeks,
that again. Yep.
and I want to talk about that. But the last question I have about where you are now is: do you see many parallels between, you know, especially venture tech investing into these startup companies that are obviously very popular where you live, to investing in mining companies, and again, particularly the junior space where you have the more venture style investing? Do you see a lot of similarities there?
That's one of my favorite questions. So, kind of from a bird's eye view, yes, no question about it. You know, both of these industries take the venture capital model, where you're making high risk, high reward bets, and if you focus on big enough opportunities, you know, a series of 10 bets, you only need one or two to pan out for all your losses to be amortized, and then for an acceptable rate of return on top of that. And so I think intuitively, both, you know, junior mining investors and, you know, the VCs in Silicon Valley understand that. And the very best investors in both of those industries focus on big opportunities. You know, just like, you know, you don't want to focus on a $100 million mine, in my opinion. You need to be thinking big. Similarly, in Silicon Valley, if investors don't see the potential or the potential scale for $1 billion idea, they'll shoo you out the door. So I think focus on big opportunities, understanding that you only need a small percentage of them to truly pan out, to make a lot of money. That's intuitively grasped between both sets of investors. However, in practice, there's a big divide, at least between Silicon Valley venture capitalists looking at the junior resource space. I think the largest thing that throws them off is the fact that these are publicly traded equities. And if anything, in Silicon Valley right now, the model is to keep the companies private for as long as humanly possible, to juice up that valuation as high as possible, and then frankly to dump it onto an unsuspecting retail audience upon the IPO. That's kind of been the game plan over the past 5 or 6 years, and how a lot of these investors have made money, to be frank. And so that's really in direct conflict to what we see in the junior resource space, where there are, of course, private companies out there. There are a lot of companies with sub 100 million, sub 50 million, sub $10 million companies that are already public on the TSXV or the CSE or what have you. And for these venture capitalists, that really throws them for a loop. They view that as a penny stock, or, you know, as a especially risky proposition. Even though at the end of the day, whether a company is private or it's public, they both have a valuation, and all you have to do is multiply the share price times the outstanding shares, and whether it's public or private, that's ultimately all that matters to a value investor. But I've observed that the disconnect for these VCs is pretty extreme, and it will potentially reconcile. You know, if we're at the peak of a mining bull market in 5 or 6 years here, I could see a lot of VCs coming in at the top and trying to adapt their thinking, but there's a lot of resistance there for kind of the junior model up in Canada with the early listings and what have you.
Yeah. Now, you know, that leads me to a question, and it's something I've been, and we're getting down a bit of a rabbit hole with this, but I've been thinking about this for 2 or 3 years now. And part of me, I don't think I can back this up, but part of me has a feeling that in the future, we're going to see early stage mining and exploration companies financed more and more privately. And part of that is due to the success we've had at Resource Insider in financing, in helping raise money for private companies, and the successes that we've had when they do go public at a significant premium. From our subscribers, we get a lot of we have a strong audience that has a lot of interest in that model. And what I wonder is, are funds like yours, or maybe even some of the bigger institutional investors, are they going to come into that in the next year, 5 years, decade? Or do you think we'll stick with this traditional Canadian junior publicly listed model? My feel is we're going to see it go more private, but frankly, I don't actually have anything to back that up.
Yeah, well, that's an interesting thesis. And if it did go more and more private, I would say that would make it easier and easier to attract kind of US generalist investors that are used to that kind of angel investing or seed
Yeah,
stage investing model. I think that would kind of start jiving more with their framework. For me, that causes a bit of issues. I mean, we do technically do private investments, or it's within our mandate to do private investments, but as a fund manager, and if you're not investing out of a PA, those can create a lot of administrative complications, especially if the company in question doesn't go public in the timeline that you anticipated and
of
ends up
course.
being a
Yeah.
private investment that just lingers in the portfolio for years and years. So, I mean, we've done 4 private investments over the, 8 odd years that we've been in existence. So I'm quite picky, but if it's truly the right team at the right valuation with a clear and defined path to going public, either through an IPO or an RTO or what have you, then that's something that I'll take a close look at.
Do you think over the next, I was going to say the next year, but maybe over the next couple of weeks at the rate we're going, we're going to start seeing some of the money that's been focused on tech, and we can broaden it out to general equities in general in the US, start to come into the mining sector, start to come in the precious metal space? Do you think we're going to see the change from this obsession with these big tech focused growth stories to more hard assets and things that are real and things that people can kind of know that are there and have a real inherent value?
Yeah. Well, I mean, I think it is inevitable, but the question of timing is difficult. I mean, this has been a 10-year run, 12-year run of, high tech, consumer focused, basically the rest of the stock market, to be honest, leaving behind the hard assets year after year after year. And at some point there is going to be a reckoning here. This is how it always works. In terms of timing, probably precious metals will, move more quickly than base metals or agriculture, industrial materials, or what have you.
Yep.
But I do think we'll start to see a rationalization here. And obviously the fact is bandied about that, Apple has a market cap, many times above the entire market cap of the gold space combined, which I don't think is necessarily sustainable. So I do think, as Friedland says, we are in for a period here of the revenge of the miners. Whether that happens over the next 6 months, though, I'm less certain. Over the next 5 years, much more certain. Over the next 10 years, almost positive that will be the case, because the divergence has been extreme. And if you look at the commodity prices relative to the S&P, or look at the values of the miners relative to the S&P, we're at multi-decade lows, and that's always a good time to be deploying capital.
So let's talk about that and what the hell is going on right now. We've seen the most volatility, I don't know, in decades, maybe in a very long time. We saw the biggest gold run in US dollars in history yesterday, and it's basically continued today. I think, we were talking about this before I hit record. We were up something like 10% in the last 2 days. What do you see is going on here, and how are you managing this as a portfolio manager? Are you deploying capital right now? Are you rejigging your portfolio, or are you just kind of like waiting and seeing for the right time to get back, or not to get back in, but to get further in and move things around?
Good question. I mean, absent really today, what we have been seeing is broad-based panic, and that's been the case for multiple weeks now. That's why we saw gold get sold off ruthlessly at the beginning of this panic. Not because gold's not going to do well in these coming months, but just due to margin calls, redemptions, collateral requirements, and potentially ignorance as well. People thinking, oh, well, I bought gold to protect me, and it's dropped 200 points when the rest of the market's falling. Gold's not working anymore, I'm out. Mm-hmm. But I think a lot of those investors have largely been shaken out. In terms of the precious metal space, 2 Fridays ago, March 13th, that truly did look like capitulation-like behavior. My opinion in the days and like week and a half after that it actually wasn't, and that we'd see one more big downdraft. But of course, that was the day your listeners might remember. We had the GDX down intraday 35%, GDX down 30%. JNUG, which is a levered ETF, and of course we don't play in any of these ETFs, but as a market participant, it's worth at least keeping an eye on them. We had the JNUG, which is triple levered down, basically nearly imploded, fell from the up above 90 the week before to, $2 or $3 and nearly blew
Yeah.
up. So that looked like sheer panic selling. I was a bit skeptical that was the bottom. The price action we've seen in the past couple of days, though, for gold, and now today the gold equities, has been quite compelling. So I'm maybe leaning towards that was the bottom, certainly for the gold price. I think
Yeah.
it's looking more and more likely that for gold equities that was also the case. However, I'm not chasing, and I want to make that very clear. And then to
Yeah.
kind of address kind of how we went about this, I think a good strategy for periods like this is to take your holdings, list them out on a piece of paper one by one, go through them, and look at the bottom 15 or 20% where you're maybe a little more shaky on the story, or it's just frankly high risk. And in a better market environment, it would do quite well, but you have concerns. Maybe they need to raise capital this year. That's obviously a big no-no. Even with the catalyst before then, this is going to be a very tough 9 months for juniors to access capital. And just look at your holdings holistically and really only stick with the ones that you can truly not see your portfolio without, if that makes sense.
Yeah.
And so
So
about
that's
kind of 2
interesting.
weeks
Yeah.
into the panic selling, we trimmed about 20% of our positions. So no panic, no knee-jerk reaction, none of that, but just looked at the holdings holistically, and took money off the table from some of the names that I think had the higher downside than others. And so we went into this year almost fully deployed. So don't get me wrong, it's obviously been a rough few weeks here. But between some of that selling, we also had some investor inflows earlier this month. We're in the 15 to 20% cash range right now, which gives me comfort, and gives me confidence to kind of hang in there. And so I think for investors that haven't taken this opportunity to kind of cull their portfolio a little bit, again, you don't have to do anything dramatic, but taking money off the table for some of the names that are a little more speculative, have more downside. Days like today are a great day to do that. You can sell into the strength, have 20, 30 cash hanging on the side, the rest of your money deployed into the holdings that you truly can't see yourself not holding, and then going from there. So we're definitely not chasing. We have limit orders, pretty deep stink bids below some of our current holdings, 25, 30, 35% below. If those hit, then great, I'm getting good values. If not, and we see the whole mining space move from here, then we're close to 80% exposed already. So God bless us. But I don't think we're just gonna, even though on days like today, it's exciting to see a bunch of green, we're not going to just skyrocket from here. There's going to be extreme volatility. Precious metal stocks maybe did see their lows already, but I think there's more pain coming ahead for basically the rest of the commodity complex, whether you're looking at base metals, energy metals, industrial materials, ag, what have you. I think the worst is yet to come.
So yeah, I agree with you on much of that. So I think you're probably right that we've seen a low in gold price and precious metals, or not precious metals, in gold particular. But I don't think we've seen a low in equities. And the reason for that is, and I'm speculating at this point, but I do wonder if we're going to see more and more mine shutdowns. We're seeing it in countries like Peru. I was talking to Ross Beatty last week, and he's talking about Pan America having to shut down their operations there. And I think it's very likely we start to see this more and more and more and more around the world. I don't know. I hope I'm wrong. But if we do see that, one, we're going to see equities get crushed, and two, we're going to see actual physical metal go way up, I think, when you start seeing these miners actually shut down. So what I think about now is, okay, if we're repositioning our portfolio, and I did almost exactly what you said, I kind of cut the bottom 15% a week ago and started to redeploy it. The areas that I kind of want to be in this scenario are royalty and streaming companies, which I think will get hit really hard when they have their streams shut off, and it'll be great buying opportunities because they're not going to suffer any of the operating costs associated with keeping something on care and maintenance. And the other thing is maybe cheap development companies as well, right? And I haven't gone out and bought any of these yet, but I think of something like Integra Resources that has just raised a shit ton of money last December. They're cashed up for at least the next year. They're trading haven't checked it today, but I think they were down to half of what they were at one point.
Mm-hmm.
They're not going
Liberty Gold,
anywhere.
Liberty
Liberty
Gold,
Gold,
another one
yeah.
potentially U.S.
But it's
based.
like you have these things that, like, for them to just sit and do nothing is relatively inexpensive with respect or with comparison to an operating mining company, right? That has big
Yeah.
staffs and all the things associated with putting a mine on care and maintenance. I haven't bought any of them yet, and I'm kind of waiting for this moment. In some parts, I hope I'm wrong that this happens, but I think that we still might have that in front of us in the next, I don't even want to give a timeline, weeks, months. We'll see.
Yeah. No, I think, I mean, we're completely aligned on the royalty names in particular. Precious metal, base metal. I think putting in stink bids 15, 20, 25%, 30% below, and crossing your fingers that they get filled in the coming months here could be quite a good strategy. Those are, I mean, that business model's taken the mining space by storm, especially in North America over the past 15 years. Those are going to be the first companies that bounce once equities have bottomed. You know, cheap developers make sense as well. You know, Liberty and Integra are not holdings of the fund, but I think they both look like high quality options at the moment. The one slight negative is that they are both U.S. based, so you're not seeing the advantage of like a falling Canadian dollar. So if they were just north of the border, that would make them even more attractive in my mind. But to me, if you can buy good quality companies with good people at good prices, you know, putting too much stock in the FX differences, I think you're kind of getting a little too greedy there.
Well,
but I
a
also
friend of mine was. Sorry, I
Sorry,
was going to say a friend of mine was making the case for Agnico Eagle, actually, given that, one, a lot of their operations are in Canada. And two, they're in very remote jurisdictions, right? So you have their mines up in Nunavut, you have their mines in northern Finland. So you're in areas that, in theory at least, are less likely to be shut down, given their sort of their isolation, their self-isolation. And then you get lower oil prices in an operation where that makes up, I don't know what the number is, but probably a very, very significant chunk of their operating costs. And you get that currency bump as well by being Canadian.
Yeah. No, it's going to be disruptive for everybody. I mean, even Agnico, I think this was just yesterday, but they're for their Meadowbank and Nunavut-based mines, they're sending about half the workforce home, especially those that live in the local communities. Because but the workers that are kind of fly in, fly out, or from elsewhere in Canada and are living in the local communities, they're still keeping things up and running. But I think they're worried from a CSR perspective, it'd look really bad if the disease spread within the local communities and they started at the mine. So I think they're watching their brand as well there. Which is probably
especially a lot of those will be Inuit communities as well, and they're very remote and they have limited access to healthcare and et cetera, et cetera. A lot of challenges that go with that. So it makes a lot of sense.
The very final thing that I'd bring up that I focused on would be cheap explorers, like very cheap, like prospect generators or early stage development plays where company is trading at / below cash. And we're starting to see those opportunities out there. I remember one of our very best successes was buying Almadex Minerals in late 2015. And at that time, you added together their cash, their marketable securities, their bullion holdings, because they own physical gold, and it exceeded the company's market cap by 1 or 2 million. So you're able to get the whole rest of the company for free. It came with drill rigs, it came with the NSR on Ixtaca, it came with a large property portfolio in Mexico. Sure enough, their first drill program, they drilled at El Cobre, which is now within Azucar Minerals. They made a discovery. We made a 10-bagger in 9 months on that one. And that's obviously a very best case scenario. That's not going to happen at all. But there's an example of buying a company below cash, so your risk is kind of limited. But since they are still in the exploration stage, if they get things right, it can work for you in a big way. So yeah, we are starting to see some prospect generation groups and early stage kind of development companies that are trading near cash position. You don't have to go out and buy them today, but maybe put in a stink bid, where if they fall 15, 20, if you want to be very aggressive, 30% cash, those are starting to get to margins of safety that even, Ben Graham would be proud of from a value investing standpoint. So I think that's another kind of area to look at for those with a bit of a higher risk tolerance. But no doubt, the least risky would be looking at the royalty names. Second least risky would be looking at the high quality, well cashed up kind of later stage development plays that you looked at. But I also think as these juniors potentially get cheaper, there's opportunities amongst the smaller names as well. You just have to make sure that they're really cashed up.
Yeah, and I think, this is such a good time for people that are thinking about entering the mining or the gold space in particular who haven't done it yet. We've done a lot of outreach to different groups. I get on a lot of these, like, why do millennials want to invest in mining panels and conversations? And I don't think there's ever been a better time, if you've never entered the space before, to take whatever it is, the amount of money you want to deploy, whether it's 10 grand, whether it's 100 grand, and sort of dividing up, doing what you said before and building that portfolio and understanding you're spreading that risk across, call it 10, 15 names, and that it only takes one or two of them to do well for that whole portfolio to be really, really successful. And we're in an environment right now where if you're half intelligent about it, everything can do pretty well.
Mm-hmm. Just be cautious. And if the company needs to come back to market, as I mentioned earlier, really within the next 12 months, like, it's not worth buying the common shares, in my opinion.
Yeah.
Not now. If things turn dramatically, then I guess you could get more aggressive. But for those scenarios, I always just would rather wait for the private placement, where you can often get in at a discount to market potentially, and maybe with a half warrant or a full warrant sweetener. And I think that's always the better strategy, especially in this environment where the market knows you need to raise money in the coming months. Like, there's going to be a financing overhang, and your share prices, unless there's some stunning news that you release, you're not going to move at all. And if you move at all, it'll be down. So
well, I think
you have to be very
totally
patient
right.
as investors, and not see days like today where there's a lot of green on the screen and start chasing things. That's just not the strategy that's going to work in this environment, because it's going to be choppy for everything.
You talked about these advantages you get in private placements, and in Resource Insider, all we do is find private placement deals for ourselves and our members. And right now I'm getting a ton of inbound requests for meetings and people pitching deals. And, we're being extremely, extremely selective in this environment, but I think it's very indicative of the fact that we're going to see some really, really cheap deals over the coming months. And we're going to be able, not we, but investors are going to be able to set their price. So if you are an accredited investor out there and you're listening to this, I think get yourself a good newsletter, get yourself a good broker, get yourself someone that can get you access to these sort of things, because I think not today, but later in this year, we're going to see some really, really, I would say, unique and rare opportunities.
Yeah, you're right, though. There'll be a lag. Won't happen today. It might not even happen 3 months from now, because with these share prices in the gutter, juniors are going to try to scrap along for as long as they can without having to bite the bullet and raise cash. But unless we see the market dramatically turn, they'll probably capitulate later this year. And that's where enterprising investors can get some particularly attractive terms. But of course, I would emphasize, got to focus on the company quality, got to focus on the quality of the people, got to focus on the quality of the asset, got to focus on the company's financial structure, got to focus on upcoming catalysts. Good deal terms are great, but it has to be with a high quality outfit, or you're doing yourself no favors.
Yeah, 100%. So, Matt, I think that's a good place to leave it for this conversation. For those who are interested in learning more about you, about MJG Capital, where should they check that out?
Yep, just come to the website. That's www.mjgcapital.com. We have our investor letters since the partnership's inception listed, recent press and podcast appearances and what have you listed, pictures from site visits that I've done, which unfortunately I had literally 3 scheduled for next month, and they've all been canceled, as you can imagine, with what's going on with coronavirus, which is unfortunate. And then there's also a contact form for any investors that are interested in the partnership, learning more, or simply just want to talk shop. I always like interacting with investors out there and seeing what they're interested in, and happy to share my opinions if you have any names that you have questions on.
Awesome. All right. Thank you very much, Matt. Appreciate your time today.
Thanks for having me, Jamie. Enjoyed the conversation.